Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Today, we're doing a deep dive into something absolutely fundamental: the art of objectivity in trading. And look, this isn't about finding some new indicator, right, or nailing market timing. It's really about a course shift in how you, the trader, relate to uncertainty itself. We want to move you away from chasing certainty, because honestly, that's a trap, and get you squarely focused on mastering probability. Because here's a truth bomb, maybe a bit disruptive. Traders don't lose because they can't predict the market. They lose because they keep trying to predict it. The real goal isn't being right every single time. It's about staying objective enough to just play the odds consistently over the long haul.
That's absolutely spot on. And if you're serious, truly serious, about getting past those common psychological hurdles, the ones that, frankly, wipe out most accounts, then this deep dive is, well, essential. Objectivity isn't just nice to have. It's basically the threshold for professional trading. You see it again and again. The top performers, they aren't necessarily, geniuses. They just manage that internal battleground way better. They achieve what we often call emotional neutrality, even under fire.
Emotional neutrality under fire. I like that. It sounds intense, almost like a military precision. So when we talk about objectivity in a trading context, maybe from a more clinical perspective, what does that actually mean? What does that state of mind look like when, say, the market's ripping against your position?
Right. And it's fascinating because the definition has to be precise, almost quantifiable, to be useful. Objectivity in trading. It's the ability, the consistent ability to make decisions based purely on your data, your probabilities, your predefined rules, and crucially, not based on emotion or bias or just the random noise you hear every day.
So it's like mental armor.
Exactly. It's core mental armor. The objective trader doesn't react based on hope or fear. They respond only to what the market is actually doing right now. And you really have to burn this into your brain. Certainty, it's an illusion in the markets. Probability, that's the language professionals speak.
That's such a critical insight because, we're almost hardwired to seek certainty, aren't we? But we're operating in an environment that thrives on, well, chaos, uncertainty. It creates this huge mental tug of war. So if we know intellectually we should be objective, why is it so damn hard? Why do we keep snapping back to those impulsive subjective calls? What's the deep psychology making us act, well, irrationally?
I know you're touching on our basic programming,
Yeah.
our evolutionary wiring. The human brain, it evolved for survival in a very different world. It craves certainty. It desperately wants patterns, control of allocation now. But markets, they live and breathe in that space of irreducible uncertainty. So there's this constant internal war going on. The deep-seated need to know for sure versus the discipline you absolutely need as a trader to accept not knowing. And if you don't actively manage that conflict, your brain will literally start hallucinating certainty where there is none. And that leads to, well, often catastrophic errors, big mistakes.
Wow. So the subjective trader is basically fighting their own biology every time they place a trade.
Pretty much, yes. Absolutely. Objectivity then becomes this art. It's like surgically detaching your own identity, your ego, from the outcome of any single trade. Think about it. If your self-worth gets tangled up in whether a trade wins or loses, you simply cannot achieve that neutrality. You have to train yourself to think purely in terms of odds, risk, expectancy. Not absolutes, not right or wrong. Real mastery, that click moment. It happens when you stop asking that really self-defeating question, is this trade going to win? And you start asking the much more clinical, professional question. Does this setup, based on my rules, actually have an edge?
Okay, wait. Let's pause on that word edge for just a second because it feels central here. In this context, thinking about psychological neutrality, how does an objective trader really define that edge? How do they measure it?
Good question. An objective edge is it's quite simple conceptually, though hard to execute. It's just a statistically verifiable asymmetry that works in your favor over a large enough number of trades. It's not even necessarily about having a super high win rate like 60% or 70%. It's a quantifiable belief backed by your own testing and data that your specific process, your setups, have a positive expectancy before you factor in costs.
Okay, so it's math, not magic.
Exactly. Math, not magic. The key is once you've actually defined and verified that edge through solid research, your job completely changes. You stop trying to be a predictor, a fortune teller. You become an executor. Objectivity is simply the discipline needed to execute that mathematically proven edge again and again, regardless of how you feel about this one particular trade right now.
That shift from predicting to just executing a defined edge. That's huge. That reframes everything. Okay, let's get really practical then. What are the specific things we actually see? the characteristics of traders who've really got this objective mindset down. What are they doing differently when they're actually trading?
Yeah, we can definitely break that down. There are probably 4 core features that really define how they operate day to day. First one, simple concept, brutally hard in practice. Detachment from emotions. They just don't let fear or greed, or maybe worst of all, frustration, dictate what they do. Think about that classic situation. You're in a trade, it goes against you, hits your predefined stop loss.
Yep. Painful moment.
Right. The subjective trader, they start bargaining. Oh, maybe it'll turn around. They hang on. Hope kicks in. That sunk cost fallacy takes over. The objective trader executes the stop instantly. No debate. They just acknowledge it as a statistical cost of doing business and move on.
That execution right at the stop, that's like the ultimate acid test of sticking to the plan, isn't it? Because it forces you to accept the loss is real. Okay, so detachment is number 1. You said 4 features. What's the second?
Second is rigorous adherence to a trading plan. And I mean rigorous. This means every decision flows directly from a predefined strategy, not from impulse, not some gut feeling, not chasing momentum suddenly. So if their plan says, based on volatility calculations, scale out half your position at price X, they do it.
Even if the market's suddenly screaming higher.
Even then.
Yeah.
They don't suddenly get greedy and think, oh, maybe I'll hold the whole thing because the news is broken, it's flying. No, the plan dictates the action, period.
Right. The second you override the plan because of a feeling, you've just thrown subjectivity and randomness right back into your system. You've contaminated your own data.
You got it. Precisely. Third feature, avoiding bias, both cognitive and external. This is huge today with the sheer amount of noise out there. Objective traders are masters at filtering. They filter out their own wishful thinking, sure, but also market news, that Twitter hype, tips from friends, if it conflicts with their established, tested strategy.
So they ignore everything.
Not everything, but anything that isn't part of their proven edge calculation. They understand that conviction based on opinion, or what everyone else is doing, is toxic to performance. You don't just jump into a meme stock because social media is buzzing. You wait for your setup based on your data to signal an entry.
Man, that takes serious discipline, especially when that noise seems right. Even just temporarily, it's hard to ignore the crowd. Okay, what's the last one? The final feature.
The fourth is dynamic adaptation to market behavior. Now, this might sound contradictory to sticking to a plan, but it's not. It's the ability to be fluid, to react only to what the price action is actually telling you, rather than stubbornly clinging to what you thought should happen.
Okay, so it's about reacting to reality, not your forecast.
Exactly. If the market clearly invalidates your setup, let's say a key support level you based your long trade on just shatters, the objective trader adapts. They adjust, maybe reverse their position, or simply get out. They don't just sit there holding on to their original bullish idea, basically doubling down on a premise the market just proved wrong.
That list, detachment, plan adherence, avoiding bias, adapting to reality, that's a really powerful checklist. If you find yourself stumbling on any of those, subjectivity is creeping in, maybe to kind of pull this together, let's try a metaphor, something visceral. Trading without objectivity, it's like trying to sail a ship blindfolded. Sure, you might catch a lucky gust of wind once in a while, right? But you'll never, ever navigate a real storm. Objectivity, that's your compass. It doesn't tell you where the wind's going to blow next, but it tells you exactly how to adjust your sails with precision, guiding your actions regardless of how choppy the emotional waters get.
That's a great way to put it. Precision, guided process. Exactly. Now, look, we both know defining objectivity is one thing. Actually doing it, implementing it consistently, that's where most traders fall down. That's the performance gap. So for everyone listening right now who's thinking, okay, I get it, I need this. How do I actually build this? We've got a practical 5-step framework. This is designed specifically to help you actively develop that objective mindset.
All right, perfect. Let's get into the how-to. Moving past the theory into action. Walk us through these steps, and maybe focus on why even experienced traders sometimes struggle to stick to them.
Okay. Step 1, build a clear trading plan.
Yeah, everyone says they have a plan, but few execute this with the required level of detail and seriousness. Your plan has to explicitly define, in writing, your entry conditions, your exit points, both profit targets and stops, position sizing, risk management rules, everything, black and white. The real purpose here isn't just to have a plan, it's to create an external logic system, a guide that you must consult before the heat of the moment, before emotion grabs the steering wheel. If the setup doesn't meet the written criteria, the trade simply doesn't exist for you.
The plan becomes your objective anchor.
Okay.
But like you said, sticking to it is the real fight. How do we measure how well we're doing that? That flows right into step 2. Track every trade, objectively,
Yeah.
And this needs to go way beyond just looking at your P&L. That's a lagging indicator of behavior. You need a detailed journal. You must review your reasoning for taking the trade, your emotional state before, during, and after, and critically, how closely you actually adhered to the rules in step one.
So tracking deviations.
Exactly. We strongly recommend tracking deviations. How often did you break your rules? Why? This lets you systematically pinpoint where and why bias is sneaking in, not just when you lost money. You can't fix a problem you haven't objectively measured against your own standard.
Okay, so we define the standard, then we measure our adherence. Once we see where we're deviating, we have to tackle the internal pressure, right? That leads to step 3.
Step 3. Practice emotional detachment. This is, without doubt, the hardest step for most people. It really is. It's about relentlessly focusing on executing your process correctly, rather than obsessing over the outcome of any single trade. When you have a winning trade, fine, acknowledge it, note it down, but don't throw a party. When you have a losing trade, fine, acknowledge it, note it down, don't beat yourself up. Both wins and losses are just objective feedback on how well you executed your edge in that instance. They are not a reflection of your intelligence, your worth, or your identity as a trader.
But hang on, the outcome is what pays the bills, right? How do you actually stop your brain from registering, say, a 2R loss as a kind of personal failure? It feels like failure.
You have to reframe it consciously. You frame it as a necessary cost of doing business, like inventory spoilage for a shop owner. If your system, your plan from step 1, truly has a positive expectancy over time, then every trade taken according to that plan, win or lose, is actually moving you closer to realizing that overall positive expectancy. So when the loss happens, the objective internal dialogue isn't, oh no, I failed. It's, okay, the plan was executed correctly. This was the statistical result predicted by the system's parameters. Analysis replaces emotion.
Got it. So you shift the internal reward mechanism from the P&L on this trade to the perfect execution of the process itself.
That's the core psychological shift, exactly. Okay, next we need to manage our environment. That's step 4. Step 4, limit external noise. This is more critical now than ever with the 247 fire hose of information. You have to be almost surgical in filtering out market opinions, breaking news alerts, social media chatter, tips from your cousin, anything that isn't a specific defined input into your trading plan.
Mute notifications.
Absolutely. Mute notifications, curate your feeds ruthlessly. Understand that these external sources are often designed to trigger emotional responses, fear, greed, FOMO. And that emotional activation directly undermines your objective stance and pushes you towards impulsive actions that deviate from your edge. If it doesn't help you execute step 1 better, it's noise. Cut it out.
That requires real disciplined isolation, doesn't it? Because we're social creatures, we seek confirmation. The step demands we consciously ignore the herd, even when it feels, well, lonely.
It can feel lonely. Professionalism often does. And that brings us to the final step, step 5, which ties it all together. It makes it a continuous improvement cycle. Step 5, reflect, learn, and refine. After every trading session, maybe daily, maybe weekly, depending on your frequency, you must sit down and review. Ask yourself honestly, did I trade my plan today or did I trade my emotions? Use that deviation tracking data from step 2. Where did I follow the rules? Where did I break them? And why? Objectivity isn't some fixed state you achieve once. It's a skill. And like any skill, it gets rusty fast if you don't practice. It only sharpens through that rigorous repetition of execution, followed by honest, objective review against the standard you set in step 1. This lets you continuously identify and remove those subjective leaks in your process.
Wow. Okay, so this 5-step framework, it's not just about making fewer mistakes or having better trades, is it? It sounds like it's about fundamentally rebuilding your mental architecture for how you deal with uncertainty. If you genuinely commit to executing these 5 steps, it seems like you change your entire relationship with market volatility. You stop being a victim of randomness and start becoming a disciplined manager of probability.
That's precisely the goal. And that leads us to the final, maybe provocative question you need to ask yourself constantly.
Yeah.
Do you trade what you actually see on the chart based on your rules? Or do you trade what you want to see, what you hope will happen? Certainty is the amateur's trap. Probability, that's the professional's freedom. The very moment you stop needing to be right on any given trade, that's the moment you truly start trading like a professional.
That's it. That's the mindset shift, the key takeaway for everyone listening. Focus on implementing these steps, prioritize the process, and watch how your execution consistency and ultimately your long-term results begin to transform. Really powerful stuff. Thanks for breaking that down for us. Trading an edge where psychology meets profitability.